Is the new 401k catch-up contribution rules enough? Starting in 2025, there is now an opportunity to add even more money to your 401k or solo 401k, especially if you're between the ages of 60 and 63 years old. This video will introduce the new 2025 super important catch-up contribution rules, how you can best take advantage of them, and I'll then share my insights and thoughts whether they're enough. I'm Adam Bergman, tax attorney and founder of IRA Financial. I've also written 9 books on self-directed retirement accounts, and my 10th I'm working on right now, and it's actually on the solo 401k plan. So there'll be a new section in that book that's going to address these very specific and new catch-up contribution rules that pertain specifically to folks ages 60 to 63 years old. So let's get started. 2025, thanks to the Secure Act 2.0, which was passed in December 2022. Yeah, it's hard to believe. It's been a couple of years. There are now special catch-up contribution rules for folks that are age 60, 61, 62, and 63 years old. So what are the rules? So in 2025, if you have a 401k plan or a solo 401k plan, you can make employee deferrals in pre-tax or Roth, dollar for dollar, of $23,500 and then $31,000. And that was the original catch-up, right? If you're over 50, you get to put in $7,500 more and get to that $31,000 number, which is great, right? The idea behind that is, hey, as you get older, hopefully you have higher income earning potential, and you realize how much more retirement savings is important, so you put away more in your retirement account. We know the IRA is a catch-up contribution over 50 of $1,000. That goes from $7,000 to $8,000. So this new special catch-up contribution is if you're between the ages of 60 and 63 years old, you can now, instead of putting away $30K as an employee deferral, you can do $34,750. Okay, so you get a little bit of a boost, a additional super catch-up, you can say, if you're between the ages of 60 and 63 years old. Now, this only applies to 401ks, solo 401ks, 403bs, 457s. This does not apply to IRAs. Then, obviously, if you have a solo 401k, you get the profit sharing contributions. And when you aggregate everything together, you can go $70,000 if you're under 50, $77,500. And if you're between the ages of 60 and 63, you can go all the way to $81,250. So in my opinion, it's a great start. Is this enough? No. It's like, why not give people ages 60 to 73? Why don't you expand that range? Now, of course, the IRS is focused on tax deductions. So if you're so focused on tax deductions and you don't want folks putting in so much money for an extended period of time to increase tax deductions, then maybe you make a super catch-up only Roth, right? So this way it doesn't impact Treasury because there's no tax deduction, but you're giving folks a chance to save more in a retirement account. Why do you want to save more in a retirement account? Very simple, right? Your money grows faster when it's not subject to tax. That's known as compounded returns, tax deferral. So of course it makes sense. Every smart investor knows that you want to maximize savings in a retirement account. The catch-up contribution, the new rules, is a nice little gift that hopefully will help us all save more for retirement. Thanks so much for watching. Don't forget to like and subscribe to the channel. I'm here to help. I'm here to educate. I'm a tax lawyer. I know this stuff. I'm here to help you guys so you can all become better, smarter, and richer retirement investors. And using the U.S. retirement system, whether it's an IRA or 401k, that is the smartest and most tax efficient way to generate real retirement wealth.